Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Market uncertainty continues as the war in Ukraine rages on, and volatility is a normal occurrence these days. And on top of that, the U.S. Federal Reserve officially began tightening monetary policy last week. So the question is, where does that leave us as investors? So we're going to discuss that right now with Eddie Ghabour, co-founder of Key Advisors Group, LLC. Eddie, always nice to have you. Thanks for coming back.
It's my pleasure. Thank you for having me.
Sure thing. So, Eddie, since the last time we spoke, which has been a couple of weeks, a lot has changed in the markets, and some things have stayed the same, which we're going to talk about in a moment, including inflation, et cetera. But we really have to talk and start off with what's going on with the ongoing war in Ukraine. First and foremost, our thoughts always go out to the people of Ukraine who are suffering through this crisis. But on top of that, there's a lot of concern about the economic implications, not only here in the U.S., but on a global scale. So what do you think are those implications of this ongoing war in Ukraine?
Look, it's just adding to the inflationary problem that we had prior to this war. You know, inflation was accelerating at a historic rate. And then this war just made gas prices and oil go through the roof. And look at natural gas. I think it hit over $5 this morning. And we are a global economy, as you know better than anybody. So you're going to have these countries going into recessions, potentially depression-like environment, and that will trickle over to the U.S. So unfortunately, the macroeconomic dynamics were already deteriorating, and this war is just going to accelerate that, in our opinion. And we think some of the worst numbers that we will see is probably going to be in this second quarter that's coming up, which is why we've been so cautious and warning clients about this time period that we're getting ready to be faced with.
Yeah, and there's a lot to talk about on the inflation side, but you mentioned natural gas. It did hit above $5. Many people obviously are watching oil prices as they skyrocket around the globe. So let's talk about oil prices, Eddie. Last week they peaked above 120. Now they're sitting at around $110 a barrel. Of course, we're talking about WTI crude. What do you think is going to happen here? I know it's hard to predict where these things will go depending on the outcome or what's happening with the talks between Russia and Ukraine, which at this point seem stalled. Where do you see oil prices?
Yeah, so I think oil from a headline news perspective is really going to be in the short term dependent on that. You know, if we get a ceasefire today, for example, you know, you would expect to see oil really plummet. But my argument to the oil and commodities for that matter is even if they drop by 20%, they're still a tremendous amount higher than where they were a year prior. And I would argue the damage is already done to the consumer because of these gas prices, as well as the other effects that you're going to see from this. You know, I was talking to a developer the other day, and the price of asphalt has gone through the roof because of gas. So it's not just the gas at the pump, it's the other factors that this really has really big implications for. And it's a big problem. So, you know, from a short-term basis, we're going to continue to stay range-bound until this war is resolved, or if it, God forbid, escalates and gets worse, it will obviously go up, in our opinion. But even if it goes away, I don't think you're going to see oil tank. You know, you're going to stay range bound within the maybe low hundreds to 80 to 85. And that's still really, really high relative to where we were.
Agreed. And there are so many far-reaching implications of the price of oil, as you mentioned, Eddie. It's not just the gas that we put in our car or ways to heat our homes. So it's a really important point. And specifically, we're talking about inflation, obviously. The Fed raised their rates 25 basis points here in the U.S. last week. 6 more hikes are expected, and Powell also raised his 2022 inflation outlook to 4.3%. So the question remains is, do you think, and you talked about this earlier when it just came to Ukraine, but continuing on the journey of what the Fed is expecting to do you think inflation is going to wane here? You know, we're still looking at supply chain issues as well with the ongoing pandemic. 50+ million folks in China are quarantined as of right now, so that might actually put another additional strain on supply chain issues, which was really the cause or big cause of the inflation that we saw in the last 2 years. Where do we sit here?
You know, it's interesting with the inflationary side, when you look at commodities as a whole, some commodities have really dropped. And I would say that's because of concerns for consumption decreasing. And then you're going to see other commodities that continue to increase, which is going to keep that inflationary level high, which is why the Fed is saying what they're saying. And so inflation is going to be very sticky. And that's why we're going to be in the problem that we're being faced with is the worst time, in our opinion, to raise interest rates and tighten monetary policy is during an economic slowdown. But because the Fed waited so long to acknowledge inflation and didn't raise any rates last year, now we're in the position that we're in now, where Powell even said yesterday that they would raise rates even 50 basis points if needed in May. I don't think there's any way in hell this market can handle, or this economy can handle, 6 more rate hikes. So in my opinion, I think the Fed is going to be forced to pivot and actually have lower rate hikes than what they're telling us, because the market and the economy is more than likely going to force their hand on that side. So they're in a lose-lose situation right now.
Yeah, so you're saying basically you think that the Fed's path right now is a little too aggressive for where we sit today.
Absolutely. I don't think the average person that's got their 401k invested or IRA invested, and this is no disrespect to anyone, I don't think the average investor understands how massive of a tightening that we are heading into based on what they're saying they're going to do. And you couple that with how fast GDP is going to decelerate over the next 2 quarters. I mean, that's a recipe for disaster if they actually follow through with that.
Yeah, certainly to keep an eye on it. And as we can all see from the consumer side, 30-year fixed rate mortgage rates went up above 4.5% as of this past week. So it's clearly it's going to be hitting the consumer as well. Could have an effect on housing, could affect your credit cards, it could affect your car loans, the rate that we'll start to pay as they continue to tighten here. So really interesting times that we have to keep an eye on. So Eddie, as we're kind of getting towards the end of our chat, I know we've talked about small caps with you. I just wanted to see, as of the last time we spoke, where do you see opportunities right now in equities, particularly in small caps, especially given the volatility, expectations for inflation, everything we talked about?
So we're very bearish short term here. We, especially again, as I continue to say, this second quarter. So we don't like small caps at all from an asset allocation perspective, because we believe the volatility on those are going to be some of the highest that we'll see if we're correct in regards to how fast this economy is going to be slowing because of the consumer being hit so hard. So the things that we've been buying are what we refer to as bond proxies. This morning when the 10-year continued to rip up, we actually used that as an opportunity to buy longer-term treasuries. We've bought utilities over the last 2 weeks. We're buying some really boring stuff, and we actually would be selling this rally in high-risk assets, because bear market bounces many times are more violent than bull market bounces. And I believe that is exactly what we're seeing right here. And we'll have to wait and see over the next 2 months if we're right or not. But we're not going to chase this thing. We think this is a very dangerous market to try to predict the bottom, especially in your higher beta asset classes like small caps.
Great. Yeah, for fixed income investors, boring is the new sexy. So it's an interesting time to be in fixed income. Eddie, thank you so much. It's always a pleasure to see you.
Thank you.
Thanks for coming by, Eddie. We'll see you soon. And thank you all for watching. For more information, you can visit our website at ubs.com/views. And you can also follow us on LinkedIn, social media in general, Facebook, Instagram, etc., Twitter. And plus, you can check out past UBS Trending episodes that we've created on demand. And as always, if you have any questions about your own portfolio, make sure to speak with your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a fantastic day. And remember to keep your eyes on what's trending. We'll see you soon.